Welcome to another tutorial video. This time around, we're going to go through a topic that is very specific to commercial banks and financial institutions groups. The reason we're doing this is because lately I've been working on a new version of our bank and financial institution modeling course. So I'm going to share with you a small portion of one of the topics that we cover in the course. That topic is known as the allowance for loan losses, or the provision for credit losses, and it's about how much banks expect to lose. Now, this lesson is very specific to banks. It's about a key accounting topic, and it's very important in this industry. But if you're not interested in banks or financial institutions, you don't need to watch this unless you really want to learn something new. So just be aware, this is certainly not applicable to the generic industrial or manufacturing or consumer retail company out there. In this lesson, we're going to cover 4 main points. First, I'm going to tell you a bit about the allowance for loan losses and how it's different from another concept for banks called regulatory capital. Then I'm going to tell you about how loan loss accounting and this item works on the financial statements. Then I'll go through a few simple scenarios to illustrate the mechanics of how this actually works. And then I'm going to tell you about how the allowance for loan losses and regulatory capital are actually related, even though they appear to be different concepts. So just to review a little bit, the business model for commercial banks is as follows. Banks collect money from customers in the form of deposits, and then they lend it out to people who need to borrow money in the form of loans. So you may go and deposit your paycheck at the bank. They collect these from thousands or millions of people, and then when a business or an individual needs to borrow money, they take some of the funds that they've collected and then turn it into a loan that they issue to whoever needs it. Now, when a bank does this, they expect to lose something on these loans because companies and people default and they become unable to pay back the loans over time due to various reasons. But when this happens, there are really 2 categories of losses: expected losses and then unexpected losses. So an unexpected loss would be if some type of disaster happens and suddenly far more people than you initially expected can no longer repay the loan. Maybe there's a natural disaster and everyone in a certain region loses their homes, or businesses all shut down, or something like that. Whereas an expected loss is something that the bank simply anticipates losing because of previous history and previous patterns related to the type of loan that it is issued to a particular customer. This tutorial is all about expected losses and also how unexpected losses eventually turn into expected losses. Now, this point about expectations is really, really important because if you don't understand this, you're not going to understand what these items really mean. To give you a real-world example, if you go to play poker and you have no real hand and you keep betting and you eventually go all in, you should expect to lose everything because you don't have any hand. You have nothing to play, and if someone else has anything, even remotely decent, that could beat what you have, you're going to lose everything. So you would go into that game and expect to lose something based on what you have. On the other hand, let's say you have a hand like a straight flush and you go and do the same thing. Now your odds are significantly better. You expect to win, or at least you don't really expect to lose with quite the same probability as you did in the first scenario. But if you keep playing and it turns out that someone else has a royal flush, you are going to lose everything because their hand beats yours. And if they stay in the game, which they should if they have a royal flush, they are going to easily beat you. So this scenario would be an unexpected loss. Now, the first scenario, for when you go in and you expect to lose something based on what you have and how the game is progressing, that corresponds to the allowance for loan losses. And then the second scenario for these unexpected losses refers to regulatory capital. Now, the allowance for loan losses on the financial statements is shown as a contra asset, and it's normally netted against a bank's gross loans to calculate its net loans. If you go to the Excel file here, which you can get to underneath the video, you can see that it's shown as a contra asset. We have 1,000 in gross loans. We have a contra asset of 10 for the allowance for loan losses. This is shown as a negative 10, and we subtract it, really add it because it's already a negative, to get to the net loans figure of 990. Now, this number will increase when we set aside something additional. So if we look at this and say, we expected to lose 10 of these 1,000 in loans, but actually now we expect to lose an additional 5. When that happens, there's an item on a bank's income statement called the provision for credit losses. And when this increases, it's going to push up the allowance for loan losses, or rather make it more negative and reduce the net loans number. So if we add something to this provision, let's say we expect to lose 5 additional on these loans, we'd record it as an expense of 5 on the income statement. It's going to reduce pre-tax income and net income. And then on the balance sheet, the allowance for loan losses becomes negative 15 rather than negative 10. And so our net loans number is now 985 rather than 990. Now, this is just about the expectation of loss. When you actually have a loan that goes bad because the borrower defaults, that corresponds to something called a net charge-off. That is going to reduce this reserve and then make the contra asset, the allowance for loan losses, less negative. So to show you how that works, if you go over once again, and let's say that we expected to lose that additional 5, and now we actually lose that additional 5 on those loans, we have gross charge-offs of 5 here. It's shown as a negative. Our ending reserve balance goes back to 10 in this case because we expected to lose something and then we did actually lose it. So it just goes back to its original starting point. And then on the balance sheet, you can see what happens. Our net loans number is still 985. The difference is that our allowance has gone down, or rather gone up to negative 10, from negative 15 to negative 10. And our gross loans number has decreased from 1,000 to 995 because we've actually lost that 5 in loans that we anticipated losing originally. On the income statement, as I said, the provision for credit losses is what increases this allowance or makes it more negative on the balance sheet. It's an expense that reduces pre-tax income and net income. The important point to note is that net charge-offs do not appear directly on the income statement. It's a little bit misleading to state this because, as we'll see later on, they do sort of show up on the income statement, but they don't appear as an explicit line item as the provision for credit losses does. So only these expectations will actually show up on a bank's income statement, and that's something very important to be aware of here. And then on the cash flow statement, the provision for credit losses is simply a non-cash add back, just like depreciation and amortization. For a bank, this is a specific item that only exists in their industry, and you add it back here. You will show additions to loans and you will show the provision for credit losses, but once again, you are not going to show net charge-offs on the cash flow statement. The net charge-offs are only going to end up impacting the gross loans figure on the balance sheet. So let's go through a few scenarios now to illustrate the mechanics of how this works, and then let's sum up the rules at the end so you understand everything here. First, I'm going to go back and just delete everything that I had entered already. We'll just keep the beginning balance at 10, but we'll delete everything else. So the first scenario is what happens when a bank expects to lose an additional $10 on its loans. In this case, we have a beginning reserve balance of 10, and we would set aside an additional 10 in provisions for this. Our ending reserve balance goes up to 20. On the income statement, we show this as an additional expense of 10, and our pre-tax income and net income go down as a result. Our cash balance actually increases here because our net income is down, but the provision for credit losses is a non-cash expense. And then on the balance sheet, our net loans number goes down by 10 because our allowance for loan losses, a contra asset, goes from negative 10 to negative 20. And all of this ends up balancing because of the increase in our cash balance. Our net loans figure has decreased on the asset side, but then on the liabilities and equity side, our common stockholders' equity has gone up because of the additional net income earned in this period. Now, the second scenario here is what happens when a bank now adds an additional $100 in loans, but it expects to lose 5. So it expects 5% of those loans to go into default because borrowers cannot repay them. Once again, I'm just going to delete this provision here. So if this happens, let's go to our loan additions in period shown and just change this to 100. And you can see all that happens here is that our gross loans balance goes up to 1,100. Our net loans figure goes up to 1,090. And then if it expects to lose an additional 5 on them, our ending reserve balance goes to 15. We show that provision of 5 on the income statement. And then on our balance sheet, our gross loans is still 1,100, but our net loans figure has declined to 1,085. Why? Because our allowance has changed from -10 to -15. So that's what happens when we have this addition of a loan and then also expectation of additional loss. And then when a bank actually loses that 5 and records the charge-off, here's what happens. We go in and under gross charge-offs, we show this as a -5. Now, nothing changes on the income statement or cash flow statement when we do this. And this is a very, very important point to note. When you actually record this charge-off, nothing changes on either of these statements because we've already set aside something to account for this in a previous period. We already have a provision for this. So the actual charge-off doesn't affect these statements when it happens. Instead, all that happens is our ending reserve goes down. Why? Because we set aside something, we expected it, and now it actually happened. So we go back to our original starting point here. And then on the balance sheet, our gross loans figure declines because we actually lost something now. It goes down from 1,100 to 1,095. Our allowance goes back to -10. And our net loans figure interestingly stays at 1,085. What's the intuition behind this? Again, we expected to lose something. So we expected our loans to decline by 5, and now they actually have declined by 5. So we expected it, and now it happened. And so our net loans figure here actually stays the same. But then something else that can often happen is when these loans go into default. It's not necessarily a complete loss because there might be a small recovery. Maybe there's collateral, maybe the borrowers suddenly reappear and they can repay some of the loan, though not everything. So something happens and there's some type of recovery here. When this happens, you show it as a recovery within the loan loss reserve calculations. So you show a recovery of 2 right here, and you can see what happens. Our net charge-offs is now -3 instead. We still have this provision of 5. Our ending reserve balance actually goes up to 12 here. The intuition behind this is that when we have a recovery like this, there isn't necessarily a guarantee that it's going to last and be there forever. It's more of a temporary thing. And so we increase this reserve because of the fact that this could always reverse itself in the future, depending on the nature of the recovery. Nothing changes on the income statement or on the cash flow statement here. So recoveries don't affect either one of those. On the balance sheet, our gross loans number was at 1,095. It goes up slightly to 1,097. And our allowance changes from -10 to -12. Our net loans number, interestingly, stays the same. So when there is a recovery and when there is a charge-off, the net loans figure stays the same because we should have already accounted for it with the provision for credit losses. With a recovery, the only difference is that the gross loans number will increase and the allowance for loan losses will become more negative. So those changes cancel each other out and the net loans figure stays the same. Now, I'm going to move into the scenario that you are probably wondering about the most, which is what happens when there's an allowance of 10, but then there's a gross charge-off of 20? What happens and how can this possibly work? We get a lot of questions about this. I'm just going to delete these numbers here so we can walk through this scenario. We get a lot of questions about this one because people often look at it and they say, well, it's impossible because if we have gross charge-offs of -20, our ending reserve here becomes negative, and then on the balance sheet, it's now shown as a positive, so it's no longer a contra asset. So how can this possibly work? And the reason this can work is that when this type of scenario happens, the bank has to increase its provision to account for this unexpected loss that's coming up. So if they look at a borrower and they can tell that someone is going to default or someone is about to not be able to repay the loan, they have to increase the provision to account for that. So in this case, they might look at this and say, okay, well, we have 10, let's increase our provision to 30. And so they would add 20 and show this provision for credit losses of 20 on the income statement. And you can see exactly what happens here. This is now enough to cover the loss, the charge-off of 20. And so on the balance sheet, our gross loans figure declines. Our allowance actually stays the same because we provisioned something additional, and then we actually lost something like we were expecting to, and our net loans figure here declines by 20 because we expected to lose an additional 20 and then we actually lost it. And so it goes down from 1,090 to 1,070. So that's the key point to keep in mind here, that charge-offs technically don't show up on the income statement, but in reality, if something like this happens where the charge-offs exceed the reserve, then the bank is going to have to set aside something additional to cover it. And so you will end up seeing the impact of that. It's just that it's not shown directly as an explicit line item on the income statement. So the key points on how loan loss accounting works are the following. Technically, only the provision for credit losses, only the expectation of losses affects the income statement. But in reality, companies are always adjusting this up and down. And so if a huge charge-off is coming up, they're going to increase the provision. And so you will see the effect of that charge-off on the income statement, even though technically it's still labeled an expectation of loss. Charge-offs, therefore, do impact the income statement, but they just do so indirectly. On the balance sheet, only the provision for credit losses and loan additions affect net loans. Net charge-offs affect gross loans and the allowance for loan losses, so they cancel each other out. So charge-offs and recoveries change the individual line items, but they don't change the net loans number. And then recoveries increase the allowance for loan losses because of the possibility of potentially defaulting once again in the future. Now, the final topic here is on regulatory capital and loan losses. And you should already know that regulatory capital is for unexpected losses. The allowance for loan losses is for expected losses. But how exactly does regulatory capital absorb losses? If you look online, you'll see a lot of people talking about how Tier 1 capital and common equity Tier 1 and total capital and so on all exist to absorb losses. And at a high level, all these numbers are essentially referring to the bank's common stockholders' equity or total equity with various adjustments included. You can go down in our file and look at some of these adjustments if you want, but that's basically what it's referring to. So how do these items actually absorb unexpected losses? Because when an unexpected loss occurs, banks have to increase their allowance for loan losses. And they do this, as you know, by increasing their provision for credit losses, which in turn increases this reserve, this allowance. Now, when you increase the provision for credit losses, it's going to reduce net income because this provision shows up on the income statement. So let's just go back. Let's just actually just get rid of the charge-off right here for now. If we increase our provision by 20, it's going to show up as an income statement expense. It's going to push down our net income. And then look at what happens down here. Our common stockholders' equity will go down as a result of this. And so all of our regulatory capital ratios will also go down as a result. So to give you a before and after here, let's say we didn't have this provision. Let's say we were not expecting to lose anything additional. Our net income here would be higher, and our regulatory capital ratios here would also be quite a bit higher, 8.6% and 12.3% for common equity Tier 1 and Tier 1 capital. But once we have this factored in, take a look at what happens. These both drop to 7.7% and 11.4%. These drop because common stockholders' equity is lower because our net income fell because we recorded this additional provision to cover this upcoming loss that we had not previously anticipated. So that is the walkthrough of how it works. Regulatory capital, in short, absorbs losses by ensuring that equity stays above a certain level, even if net income falls, because such a dramatic drop in net income most likely comes from an unexpected loss because a bank has to record the provision for credit losses when these unexpected losses occur, and it doesn't have enough in reserves to cover them normally. And the impact ultimately is that the capital ratios are going to fall, and they should do that because that's the whole point of setting aside something extra to cover these losses. And this is also why Tier 1 capital is known as going concern capital, because it can absorb losses when the bank is still solvent and up and running. Let's do a quick recap and summary now. The allowance for loan losses is for expected losses. Regulatory capital, mostly in the form of common equity, is for unexpected losses. For loan loss accounting on the financial statements, remember that the provision is all that shows up on the income statement. On the cash flow statement, you only show additions to loans and the provision as a non-cash add back. On the balance sheet, gross loans will increase when the bank issues additional loans and decrease when there's a net charge-off. The allowance for loan losses is shown as a contra asset, and this is going to be impacted by provisions and by net charge-offs. And net charge-offs will reduce this balance. Provisions will increase this balance. We went through a few scenarios to illustrate the mechanics, including what happens when a bank issues more loans and expects to lose more, what happens when there's a charge-off and recovery, what happens when there's a charge-off that is beyond the bank's current reserve balance. And then I showed you how regulatory capital and the allowance for loan losses are linked. Essentially, unexpected losses become expected losses over time when you get close enough to them to be able to actually anticipate them. And in turn, they push down net income. And that's why regulatory capital exists, to be able to sit there and absorb lower net income levels and still have the bank's regulatory capital ratios stay above a certain level. That's it for this topic. I hope you learned something new about regulatory capital and the allowance for loan losses and accounting for commercial banks, all very, very common topics to come up on the job and also in interviews with these groups.